Google's shocking move, pulling back from San Francisco and investing $40 billion in Texas. That sounds like a corporate breakup with California, but the real story is more subtle and more concerning for everyday Americans because it's not about one building or one city. It's about where the next generation of jobs, tax revenue, and economic power is quietly being redirected. In 2024, Google confirmed it would not renew its lease at One Market Plaza in San Francisco, a roughly 300,000 square foot waterfront office it had occupied since 2018. This wasn't a small satellite space. One Market Plaza sits in one of the most expensive office corridors in the country, where pre-pandemic rents often exceeded $100 per square foot per year. When a company like Google walks away from a building like that, landlords, city budgets, and local businesses all feel it immediately. This move didn't happen in isolation. Since 2023, Google has listed or vacated roughly 3 million square feet of office space across California, including major properties in Mountain View and Sunnyvale. To put that into perspective, that's more than 50 football fields of office space, no longer supporting daily commuter traffic, lunch spots, transit systems, or surrounding retail. Google's official explanation is efficiency. Like many tech companies, it now operates with a hybrid workforce. Fewer people in the office means less space is needed. That sounds reasonable until you look at where the money is going next. Because while Google is shrinking its physical footprint in California, Alphabet has committed $40 billion in new investment in Texas through 2027, focused largely on data centers, cloud infrastructure, and artificial intelligence. For the average American family, this shift matters more than it appears. Office buildings aren't just places where people sit at desks. They are anchors of local economies. Each large office supports hundreds of secondary jobs: cleaners, security staff, food service workers, parking attendants, and small business owners who rely on predictable foot traffic. When an office goes dark, those jobs don't go remote. They disappear. San Francisco is already under strain. As of late 2024, the city's office vacancy rate exceeded 35%, meaning more than 1 in 3 office spaces sat empty. Every major tenant that leaves pushes that number higher, putting downward pressure on commercial property values and, eventually, city tax revenue. That revenue pays for transit, public safety, and social services, the very things residents still rely on, even as companies pull back. And here's the key tension. Google isn't struggling. Alphabet reported over $300 billion in annual revenue, with cloud growth exceeding 30% year over year in recent quarters. These real estate exits aren't emergency cost cuts. They are strategic reallocations. California isn't losing Google because Google is weak. California is losing ground because Google sees better long-term economics elsewhere. This is the first warning sign, not a dramatic exit, but a calculated shift that tells you where the future is being built and where it's quietly being dismantled. If Google were simply downsizing, the story would end with empty offices and layoffs. But that's not what's happening. The more revealing move is where Google is aggressively expanding, and Texas sits at the center of that strategy. Alphabet confirmed plans to invest $40 billion in Texas between 2024 and 2027, with a heavy focus on data centers, AI infrastructure, and cloud computing capacity. These are not symbolic investments. Data centers are long-term, capital-intensive assets designed to operate for decades. Once built, they rarely move. When a company commits tens of billions of dollars to infrastructure like this, it is signaling where it expects stable growth, predictable regulation, and favorable economics far into the future. Texas already hosts multiple Google data center campuses, including projects in Haskell County and Ellis County. An additional expansion has been reported across rural parts of the state where land prices, electricity costs, and permitting timelines are significantly lower than in California. According to the U.S. Energy Information Administration, industrial electricity prices in Texas are roughly 25% lower than in California, a critical advantage for energy-hungry AI and cloud operations that run 24/7. Then there's Austin. Google pre-leased the entire Block 185 tower, an 800,000 square foot, 35-story office building in downtown Austin, one of the largest office commitments in the city. Although the move-in timeline was delayed by the pandemic and hybrid work shifts, Google confirmed it will begin occupying the space. That single building alone is larger than many of the San Francisco offices Google is abandoning. For the average American household, this matters because these investments shape where job growth concentrates. Data centers don't employ as many people as traditional offices, but they generate high-paying technical roles, long-term construction work, and massive local tax revenue. Counties hosting large data centers often see tens of millions of dollars annually in property tax contributions, stabilizing school districts and local budgets. Texas also offers something California increasingly struggles to provide: predictability. Corporate tax rates in Texas remain among the lowest in the country, and the state has no personal income tax. For highly paid engineers and executives, that difference alone can mean tens of thousands of dollars per year in take-home pay. For companies issuing stock-based compensation, it reduces the friction of recruiting and retention. This is not about politics or culture. It's about math: lower costs, faster approvals, cheaper energy, and a tax structure that rewards expansion rather than punishing scale. When executives allocate capital, those variables matter more than brand loyalty or history. And while Google insists it remains committed to California, capital tells the truth before press releases do. When billions are flowing one direction and leases quietly expire in another, the trajectory becomes clear. This shift sets up the next domino: jobs. Not just high-profile tech roles, but the thousands of indirect positions tied to where economic gravity settles next. When a tech giant closes an office, the immediate assumption is that employees simply log in from home and carry on. In reality, the transition is far more disruptive, especially for workers who don't appear in earnings calls or shareholder letters. As Google reduced its physical footprint in California, layoffs followed. State filings with California's Employment Development Department showed dozens of permanent job eliminations in Sunnyvale tied directly to office consolidations. In parallel, Google eliminated over 100 roles in its cloud and design-related teams, and more than 200 contractors working on AI and search products saw their assignments end. These weren't voluntary exits or early retirements. Many workers found out through internal emails, then immediately entered one of the most competitive tech job markets in years. At the same time, Alphabet posted record-breaking financial results, surpassing $100 billion in quarterly revenue for the first time in company history. Cloud revenue alone grew more than 30% year over year. From a business perspective, the cuts were not a response to falling demand. They were a recalibration: fewer people in higher cost regions, more investment in locations where each dollar goes further. For the average American family, this is where the story becomes personal. Tech layoffs don't just affect six-figure engineers. Every eliminated office role reduces demand for local services. Restaurants lose lunch crowds. Parking garages lose monthly pass holders. Cleaning crews see hours reduced. Security contracts shrink. These workers rarely receive severance packages or stock grants. When offices empty, their income disappears almost overnight. There's also a timing problem. According to the Bureau of Labor Statistics, job openings in the professional and business services sector fell by more than 20% from their 2022 peak by late 2024. That means laid-off workers are competing for fewer positions, often at lower pay, while still carrying Bay Area housing costs. Mortgage payments calculated on tech salaries don't shrink when a job does. The pressure is even greater for workers on employment visas. Losing a job triggers strict timelines to find new work or leave the country. That adds urgency to an already stressful situation and limits bargaining power, often forcing workers to accept lower compensation just to stay employed. Meanwhile, Texas is absorbing the upside. New facilities create demand for engineers, project managers, electricians, and operations staff. These roles may not always be in downtown Austin or Dallas, but they generate steady income in regions where housing costs are dramatically lower. According to the Federal Reserve's housing data, median home prices in Texas remain roughly 40% lower than California, even after recent increases. The contrast is stark. One region loses dense, high-cost jobs and the ecosystem that supported them. Another gains long-term infrastructure and growing payrolls. And the company at the center of it all reports rising profits throughout the transition. This isn't a collapse. It's a redistribution. And the people caught in the middle feel the pain long before the data reflects it. Next, we need to look beyond Google, because this isn't a one company story. It's part of a broader corporate migration that's reshaping the US economic map. If Google were the only major company pulling back from California, the economic damage might be contained. But the data shows something more systemic. Google's moves align with a broader pattern of corporate migration that has been accelerating for more than a decade and speeding up since 2020. According to research from the Public Policy Institute of California, nearly 800 companies relocated their headquarters out of California between 2011 and 2021. What's more concerning is the trend line. In 2011, roughly 150 headquarters left the state. By 2021, that number had climbed past 200 in a single year. Over the same period, the number of companies moving into California dropped by more than half. The list of departures reads like a who's who of American corporate power. Tesla moved its headquarters from Palo Alto to Austin. Oracle left Redwood City for Austin, later shifting executive operations again. Hewlett-Packard Enterprise relocated from San Jose to the Houston area. Charles Schwab exited San Francisco for Texas, and Chevron announced its headquarters move to Houston in 2024, ending more than a century of California roots. Each departure compounds the effect of the last. When a Fortune 500 company leaves, it doesn't just take executive offices, it pulls legal, teams, accounting contracts, consulting relationships, and philanthropic dollars with it. These companies anchor regional economies, and when they go, the ecosystem thins. California's vulnerability lies in how its tax system is structured. According to the California Department of Finance, the top 1% of earners generate more than 45% of all personal income tax revenue in the state. Much of that revenue comes from stock compensation and capital gains tied directly to tech company performance. When high earners relocate, or when stock-based roles move to other states, the tax base becomes less predictable. This creates a feedback loop. Declining tax revenue pressures state and local governments to raise taxes or fees elsewhere, making the environment even less attractive to businesses still deciding where to expand. Meanwhile, states like Texas, Florida, and Tennessee market stability, lower taxes, simpler regulations, and faster permitting. For families who remain in California, the consequences show up slowly but persistently. Budget gaps affect transit systems, public schools, and infrastructure maintenance. Cities delay repairs, reduce services, or raise local taxes to compensate. The cost of living remains high, but the economic momentum that once justified it weakens. What makes Google's case especially revealing is that the company hasn't officially left. Its headquarters remains in Mountain View. That's why this trend can be easy to miss. There are no dramatic announcements, just leases quietly ending, offices consolidating, and new investments flowing elsewhere. And that raises a critical question. If this is happening while profits are strong, what happens during the next economic slowdown? That's where the long-term risks emerge, for workers, for cities, and for the broader economy. Economic transitions are easiest to absorb when times are good. Right now, that cushion still exists. Corporate profits remain elevated, unemployment is relatively low by historical standards, and consumers are still spending. But the concern isn't today's conditions, it's what happens when the cycle turns. The Federal Reserve has made it clear that higher interest rates are likely to persist longer than many businesses expected. As of late 2024, the federal funds rate remained above 5%, the highest sustained level in more than 2 decades. Higher rates raise borrowing costs, slow investment, and historically lead to weaker labor markets with a lag of 12 to 24 months. This is where California's exposure becomes more severe. When companies are already shrinking their footprint during strong earnings periods, they have far less incentive to maintain high-cost operations during a slowdown. Office space that's temporarily underused during a boom becomes an obvious target during a contraction. Commercial real estate is the pressure point. San Francisco's office vacancy rate above 35% isn't just a statistic, it's a balance sheet problem. Falling occupancy pushes down property values, which directly reduces property tax revenue. According to city budget data, commercial property taxes account for a significant share of San Francisco's general fund. When valuations drop, the impact lags, but it eventually forces spending cuts. Those cuts don't land on corporations, they land on services. Transit agencies reduce frequency, city maintenance slows, public safety budgets tighten. For families already facing high rents, high childcare costs, and elevated grocery prices, even small reductions in services increase financial strain. Housing magnifies the risk. California homeowners bought at some of the highest price-to-income ratios in U.S. history. According to Federal Reserve data, the median home price in the San Francisco metro area peaked at more than 9 times median household income, compared to roughly 4 times income in many Texas metros. If job losses accelerate during a downturn, homeowners in high-cost regions have far less flexibility. Selling often means realizing losses or leaving the state entirely. Meanwhile, states receiving new investment enter downturns from a position of relative strength. Texas's growth model relies less on volatile capital gains taxes and more on property and consumption-based revenue. Large data center investments provide stable tax income even when consumer spending slows. That doesn't make Texas recession-proof, but it does make it more resilient. For workers, timing is everything. Layoffs during strong markets are painful but survivable. Layoffs during recessions are far more damaging, especially in industries already contracting. If California's tech ecosystem continues thinning out before the next slowdown hits, displaced workers may find fewer local opportunities when they need them most. This is the hidden cost of gradual exits. They don't trigger alarm bells until the system is already fragile. By the time the downturn arrives, the safety net has less capacity, and the recovery takes longer. And while this shift reshapes regional economies, it also changes the balance of national economic power, where innovation clusters, where tax revenue concentrates, and where political influence grows. That brings us to the final question. What happens next? And who ultimately pays the price? Google's gradual retreat from California and its massive commitment to Texas aren't isolated corporate decisions. They are signals, early indicators of how economic power in the United States is being rebalanced. And while these shifts unfold quietly, their long-term consequences will be anything but subtle. In the near term, expect more of the same. Leases expire and are not renewed. Office space remains empty longer. Companies emphasize hybrid flexibility while concentrating new hiring in lower-cost states. None of this requires an announcement, and that's precisely why it continues with limited public scrutiny. The absence of drama does not mean the absence of impact. For California, the risk is structural. When high-income jobs move elsewhere, tax revenue becomes more volatile. According to state budget analyses, capital gains taxes can swing by tens of billions of dollars year to year, making long-term planning difficult. If fewer companies generate those gains locally, future budgets become increasingly dependent on a shrinking pool of high earners. That increases pressure on middle-income households through higher fees, local taxes, and reduced services. For Texas and similar states, the gains come with trade-offs. Rapid growth strains infrastructure, housing supply, and public services. Austin has already seen home prices double over the past decade, and congestion has worsened. But the difference is trajectory. These regions are expanding into demand, not contracting away from it. Growth creates problems, but decline limits options. For the average American family, this shift reinforces a hard reality. Where you live increasingly determines your economic resilience. Families in regions losing corporate investment face tougher job markets, higher competition for fewer roles, and declining public resources. Families in growth regions benefit from expanding opportunities, even if living costs rise over time. Google's own financials make one thing clear. This is not a story about failure. Alphabet remains one of the most profitable companies in the world, with cash reserves measured in the hundreds of billions of dollars. The company is choosing where to build its future, not scrambling to survive. And those choices create winners and losers, regardless of loyalty, history, or local impact. No single company can reverse these trends alone, and no city collapses overnight. Economic centers erode gradually, then suddenly. By the time the damage is obvious, the capital has already moved, the jobs are already gone, and rebuilding becomes far more difficult. Google says it remains committed to California. The numbers tell a more complicated story. 3 million square feet of office space abandoned, billions spent exiting real estate, $40 billion committed to Texas. The future isn't being announced, it's being funded, and for the families, workers, and small businesses watching these changes unfold, the question isn't whether the economy is growing, it's where and whether they'll still be standing where it lands.